This is Thomas Key, President and CEO of Stock Traders Daily. I have created this presentation in sort of an impromptu fashion, but it is a culmination of all of the things that we've been talking about, and they're sort of coming to fruition. I want to make sure that you recognize them. I think one of the best ways to do that is by you hearing my voice. But look, we're a couple days away from Christmas. Having a webinar on this subject is probably not the best way to do it, so I'm just creating this video. I hope you do have time to listen to it in its entirety, because it's important. The other day, I put out a headline that odd conditions existed in the market, and those odd conditions are absolutely tangible right now, given what happened on Friday. I think everyone was a little bit surprised that the market was down 350 points on Friday. Hey, that's a big drop, especially after there seemed to be such a good reaction to the FOMC data. Why is that? Well, let's go back to what we've been talking about. We've been talking about liquidity, right? This is exactly what we've been talking about. Liquidity and the problems with liquidity in terms of new money. By the way, notice where I found that? That was in our institutional research section, and specifically that was the liquidity crisis that we talked about in September, right? And this is exactly what this report talks about. You can look at this report at your leisure by going into that institutional research section, by clicking on the free report, or the report for the liquidity crisis, and reviewing it with me. Now, I'm going to skip a couple things here. I'm not going through all the slides. This isn't a formal presentation. It's just a review, right? We're talked about stimulus in that presentation, and we talked about how stimulus influenced demand, which in essence influences liquidity in our economic system for assets, right? Assets like the stock market, in housing, and other tangible assets, businesses too. They benefited, but all asset classes benefited by the trillions of dollars that were infused into the system. That's just a simple fact. They benefited, right? But what happens now? And I went through a series of quirky discussions, I think at least, and trying to demonstrate to you that there is, in fact, a very easy way to look at this. The easy way is economic conditions are predicated on what the underlying factors of economies are based on, and that is people. People matter. And the way that we invest our money governs longer-term economic cycles. The way we spend our money creates a chaos-like boundary around them. That's been history. And history has been proven by this simple demographic observation. People matter. And if you think it's true that institutions matter more than people, remember what gives institutions power. People. So people ultimately matter, and they are the backbone. So studying people helps us identify longer-term economic cycles. And the beauty is, when we incorporate societal norms into this whole thing, we can look ahead too, to determine how investment cycles on a naturalized basis pan out. And that's exactly what the investment rate does. You can go through this and look at all the ways I've derived this data, but the investment rate is the most accurate leading longer-term stock market and economic indicator in history. Dating back to 1900, it's identified every major upcycle and every major down cycle in U.S. history in advance. Notice that 1928 to 1938, this was the first downward cycle in the investment rate. That was the Great Depression. 1969 to 81, well, that's stagflation. The upcycles in between clearly defined by the investment rate. What is this telling us? This is telling us that there was more and more new money available to be invested into the economy, into asset classes, into the economy when these upcycles existed. That means great investment opportunities for you. Buy, hold, have fun. However, in these other periods, in these periods in which the investment rate declines, there's less and less new money available to be invested into these asset classes. Hey, look, there's still new money. It's just less new money. And when there's less new money, it's harder and harder to grow. That's the simple truth, right? So it was harder to grow during the Great Depression. That's a time to be proactive with your money. That's a time to take that risk off the table, or at least protect what you have. Same thing with stagflation, right? Well, you know what? The same thing with right now, because in December of 2007, we entered into the third major down period in U.S. history, and it doesn't end until 2023. And we are in that third major down period in U.S. history right now, akin to the Great Depression and stagflation, because the amount of new money available to be invested into the economy declines precipitously during this particular time on a naturalized demographic basis. Now, notice that I said new money. New money matters because you can't churn old money and make assets grow. New money matters most. And this measure is a measure of new money, which is in effect the driving force behind growth. Again, you can go through and look at all this stuff on your own in this presentation, but the bottom line is there is quite a bit of room to continue to decline before we reach that trough in 2023. And the investment rate is measuring macroeconomic conditions based on a supply and demand factor. But we know something very, very clearly, that although the investment rate declines, and it declines aggressively between 2007 and 2014, it's declined aggressively already, but it continues to decline beyond that to 23, but we know that stimulus also existed starting in 2008. How did that influence the investment rate? Well, I don't think anyone is really thinking that the investment rate holds water right now, which is funny because it predicted the peak in 2007 almost exactly. It told us that in 2002, and it's predicted every longer-term major economic cycle in U.S. history since 1900 in advance. So why are the last few years a little bit clouded? It's because there's been trillions of dollars infused into the system, and no one is looking at the natural demand factors right now. Well, that is, maybe, until now. And that's the point of this presentation. Look, I've suggested that there is a 66% difference in the demand that appears to exist out there and the demand that actually exists on a new money basis, defined by the investment rate. That 66% difference is massive. It's not telling us that there's not demand. That tells us that the demand that's actually out there is it looks much higher than it actually is. And it looks that high because stimulus has caused it to look that high. My argument to you has always been that once stimulus comes to an end, we're going to start a reversion back down towards the mean. Reversion back down towards naturalized conditions. Those naturalized conditions are substantially lower on a demand side basis than where we are today. So, where are we today? Well, look, in my opinion, we're going to revert back to the mean. We're going to go back towards where the investment rate is. That's going to happen. But in addition to that, stimulus is clearly over, and not only that, but there's also a drain on liquidity that's happening now, and that's happening because the U.S. Treasury is still printing bonds and taking money out of the financial system. Right? They're essentially still raising debt, even though the FOMC is no longer buying their debt. So the net stimulus was positive, but now it's negative. So they're already draining liquidity from the financial system. In addition to that, though, we are essentially a little bit higher than, not quite, but I made this presentation originally in 2014. In April of 2014, the market's really not done much since then. But there was a little bit of an increase, right? That little bit of an increase, it was all due to margin debt. It wasn't due to new money. It was due to the assumption of margin debt. And when I push that a little bit further, and I compare free cash to margin debt, I noticed something that is very, very peculiar that adds to the liquidity concerns, and that is that the amount of free cash to margin debt is at an all-time low. That's a huge concern. And this was as of September. That's a huge concern, and that tells us that we're in a liquidity crisis. We are in a liquidity crisis in terms of new money. Hey, look, old money, sure, it's there, but it can't be churned to create growth. It's already gotten us to a certain level. It's the new money that matters. And if new money demand levels are substantially lower than where we're at right now, an adjustment in price is a natural condition. The adjustment in price is a natural condition, and if the investment rate and the difference between where we look like we are today and the investment rate holds any water, I mean, the adjustment in price could be 66%. It can be a massive adjustment in price. It's all about new money and the demand side of the equation. Think about it logically, right? The demand side of the equation, new money. Well, that also is a risk barometer, right? The less new money chasing after in an asset class, the less people are willing to take risks in that asset class. In stock market terms, we call that a multiple. And when risk appetites diminish, multiple contractions exist. There we go. Nothing else needs to change. All that needs to happen is that a new paradigm shift comes into play where we're thinking that risks are a little higher because demand isn't what it was, because the trillions of dollars aren't there, because we're not getting $80 billion per month infused into the system. That's today, guys. And then we're also tightening interest rates. My opinion is we're going to see very volatile market conditions. Right now, we are seeing very odd market conditions. I think we're set up for a market crash. I think we're set up for a market crash. I think it's ugly. I think it's going to be very ugly. I think a major correction is coming. I cannot be sure. I just don't know for sure. Hey, maybe everything cleans up and we just have volatile conditions and everything's hunky-dory from here. I don't know for sure, right? But I see the writing on the wall, and the writing is we've had stimulus in effect offsetting naturalized conditions. Stimulus is no longer there. The monies that's been infused into the system as a result of stimulus are now old money, not new money, and a reversion back to the mean in the new money category, the investment rate, is just natural. There's nothing that can really prevent that from happening. The question is, do risk appetites change? My answer is almost for sure. And I need you to digest that during this holiday season and wrap your head around it. Sorry for the kind of Grim Reaper news here in advance of Christmas, but look, you need to recognize this, and you just need to pay attention to this because it is ultimately one of the most important things that I think that most people can hear right now. So just let it sink in. Remain in control. Stay in control, control your risk, engage proactive strategies. I think you'll be fine if you do that, but if you start making mistakes in a market that has this much inherent risk in it, things can get ugly. So keep your head on straight. Have a good holiday.